Hello and welcome. Today we will look at the point of the figure chart. We will cover its future as well as to discuss how they are useful to day trading, scalping and swing trading, and we will also see how to stop supply and demand zone using this type of analysis. So if you could subscribe to the channel and stick around for the full video. Here we have a chart showing data from the past 24 hours. On the right we have classic candlesticks chart, and on the left point and figure chart. Both charts are showing the same thing. The display is different. The candlesticks chart displays the price as a linear function of the shown how the market behaves during certain period of time. In this example, first trading day, but the problem is that sometimes you don't need to know how price change in the time. All you need to know is what the prevailing forces and the market is the moment, demand or supply. This is where PF charts come handy. They show the price change graphically independently on the time during which the channel have occurred. Here we have 5 days of price actions points, and figure charts provide a simple yet disciplined method of identify current or emerging trends in prices. They rely only on price moments and not time intervals during the certain of the chart. This is why these charts are similar to the wrinkle. So point and figure chart introduce the importance of time on a chart and instance photos on the price moments. These charts are also excellent and flirted that non-moving days point a figure chart map out the relationship between the supply created by the sellers and the demand created by the buyers at different price levels. When demand exceeds supply, more buyers than the sellers, price rise, and this reflected by the column of excess on the chart. Conversely, when supply exceeds demand, more sellers than buyers, prices fall, and this is reflected by the column of hours on the chart. The objective point and figure chart is to identify the points which establish supply-demand relationship change. These are non-breakouts. These changes will very probably lead to the figure significant move in the prices. The green X are the price increased, and the red O's are takes decrease. A column of X represents the uptrend, while the column of O's represents the downtrend. In such particular column, there can be only X or O's when the trend ends and new column starts. So X columns represents rising prices, while columns consisted of O's denote falling prices. There are two inputs to a point and figure chart: box size and reversal amount. The X and O's that makes up each column occupy a space called the box size. The box size is the size of moment requires to add X or an O to the box size. Value is determined by each trader. When the price moves enough in the same directions as the current column, then new X or O is added to the column. When price goes far enough away in the opposite directions, a new column begins with either an X or an O opposite of the previous column. The amount that price must be moved is determined by the reversal distance. This value is created by the multiplying the box size by another value defined by the trader. The reversal amount is the number of the boxes prices must move in order for the new letter to be drawn or a new column to be created. Therefore, if the box size is set on 1 and the reversal amount is set on 3, then price must move at $3 in order to the new letter to be added to the chart. There are two different methods for the calculations reversal distance. First is average true range. This method is used when the values generated by the average trend range indicator. The ATR is used to filter to the normal noise or volatility of financial instrument. It calculates what the ATR value would be in the regular candlesticks chart and then makes this value the reversal distance. The second method is the box size. New boxes are only created when the price movement is larger than the predetermined reversal amount. The upside to this method is that it's very straightforward and it is easy to anticipate when and where new boxes will form. The downside is that selecting the correct box size for the specific instrument will take some back tests. I wish I had a perfect box size that will work for any market, but this isn't the case. We all have backs and find the right size for our trading styles. Here are some tips regarding how to set the correct size of the box if you are not using the ATR method. So the box size is based on the scale you wish to use for the particular market, and it represents the value given to each box X or O to the chart. Its minimum price charge needed to continue the thread, meaning that add an X to the top of the column X or the minimum prices decrease needed to add to O to the bottom of the column O's. The reason that this is an issue because the reversal of the $3 for the $10 stocks is more dramatic on a different scale than $3 reversal on the $100 stocks. Furthermore, since points and figure charge are used to filter out noise in the market, you will want to be sure that are filtering out enough to eliminate momentary price reversals, yet at the same time you can identify when the significant reversal is taking place. As you use a point to the figure chart, you may find a different box size work better for your trading styles for a particular market. I don't use the ITR method because I prefer to have a full control, so I set the box size manually dependent on the market I'm trading. For Fox's box size of the 10 or 20 points are a good start to brackets. For stocks value between $20 and $100, I use $1 box. For the stocks above $100, I use $2 box. If you trade penny stocks, use 50 cents for the 20 cents box. These are just good starting points. You can adjust the box size depending on the market you are trading and your trading style. Now, another important aspect considering old school traders typically prefer to the high and the low prices of the period, while others may focus strictly on the single prices such as close. Depending on the prices you see, you might get different results. There are two rules regarding to the letters and columns. Each column has be either X or O, so they can never be two different letters in some column. X columns and O columns will always alternative. You will never see two X columns side by side and vice versa. If there are three or more X and columns demand in the chart and has occurred overcome supply, the reversal is also true. Then the chart produces three O's in the column. This indicates supply has overcome demand. In this way, point and figure chart show the establishment of the trend and trend reversal in the clear and organized manner. Their usefulness lies in their ability to filter out market noise, short-term price fluctuations that occur during longer more established tunnels, they do not take trading volume into account, and they are only affected by price movements. Okay, how to use point figure to find supply and demand zone. Now that we have done through the process of the creating a point and a figure chart. Now that we have gone through the process of creating point and the figure chart, the next step is to understand how to use this chart as a part of your trading decision making process. Point and figure charts are great for the visualization, support and resistance levels, trend lines and breakouts. First, let's talk about the support and the resistance using point and figure charts. The support level is a level which trades believes prices will start with more higher after hitting the level marks. Have a look at the several O's in the example. A horizontal row of O's is what you're looking at. Looking for when they recognize on a trend reversal and uptrend to begin. A horizontal row of X makes the resistance levels you need to be looking for. The PF chart support level are identified as the horizontal row of O's, which represents a level at which demand overcomes supply, meaning where buyers feel confident to step in. Resistance levels are identified as the horizontal row of X, which represents a level at which supply overcomes demand, meaning where sellers feel confident to step in. Have a look at this chart. At this level, there is more supply than demand as sellers step in the price retreat. At this level, there is more demand than supply as buyers step and price rise. A simple analysis of the long-term point figure chart will offer reversal levels at which price consistently finds support or resistance. There are key areas for which we will be actively watching for the new point figure, but or bear chance to emerge as support. We will look for future confirmations such as selling climaxes, particularly if on high volume. But this is a more advanced topic for another video. Conversely, pay attention when the price is reaching areas when they find major resistance. They are levels at which the next price moves are likely to be a downtrend. Trend lines are very important in the point to the figure analysis. With the point and figure chart drawing trend lines is easier than with other charts because much of the subjectivity is eliminated. According to the points figure theory, when the chart doesn't distort to the price actions anymore, the rising and the falling angle of the making are close to 45 degrees. There are 4 different types of trending you can use with point and the figure chart. Bullish support, bullish resistance, bearish support, bearish resistance. The bullish support line is used to identify those markets that are in the uptrend and to alert you to potential reversal in the uptrend. Markets above the bullish support line should be assumed to be a long-term uptrends. The trend line does not create points and can therefore be drawn immediately when the uptrend begins. In this down from the lowest point made after the completion of the bear trend, a significant down move, and it is down 45 degrees angles. However, you can also draw the trend line the classic way at an angle you want and basket. Future price actions. As the rule of the thumb, you should buy prices that are trading below their bullish support lines, break a bullish uptrend line that has been in the place for the considerable amount of the time. is considered to be the bearish. Markets below their bearish resistance lines should be considered to be the long-term downtrend. The trend line is drawn from the highest point after the completions of the significant uptrend is extend downtrend at an angle of the 45 degrees as far right as possible. Again, you can experiment with other angles. Short positions should be considered while the price is below the line, and any buy signals found below this line should be this range. Break of the bearish resistance lines is considered to be the bullish event. This video was intended to familiarize you with the point of the figure chart, the basic supply and demand theory. It is important that you fully understand how these charts are forming, the box size and reversal. Without a sound knowledge of the information, it is difficult to understand the following videos and the more depth features of the point figure out. I am carefully backing this chart mainly for the support and resistance, and I must say I am having a good result. I can see support to resistance levels much clearer on this chart. I am planning another video with the main point of the figure chart contains several breakout strategies you could apply for the swing trading and day trading, but I don't know if this topic is interesting to you. I know that these charts are considered old and out of date, so if you follow up video on point figure trading, leave us a like, subscribe. This way you will know you like to see more videos of this, and check out Academy program if you want to figure level up your trading. Until next time.